The Taxpert Basis Period Reform app helps agents to advise clients on the consequences of the 23-24 basis period reform, and in particular of the likely cash flow consequences. As we'll see in this demonstration, it would also enable agents to advise taxpayers on whether a change of accounting date might have a significant effect on their current and future tax cash flows. The input screen, which I've enlarged for this initial demonstration, starts by asking us what the 2023 accounting date is. And I've put in 31st December 22. And the standard part of the 23-24 basis period will always be 12 months from the end of the 2022-3 basis period. Now, with the 31st December year end, I've then put in, assuming no change of accounting date, equal profits of 100,000 every year, but with no overlap relief brought forward. And essentially, that's the information you need to insert to get the appropriate figures as the result of these calculations. And in this relatively simple scenario, we'll see straight away that there will be an adverse impact on taxpayer cash flow because the basis period change means that whereas you would ordinarily expect 100,000 a year, it's going to be over 5,000 more than that as a result of the additional profits coming in. And if I scroll across to the right-hand side of the screen, we can see straight away the transitional part of the 23-4 tax year totals 26,230. That is spread over 5 years, so means an additional 5,000 odd per annum. And that's the automatic minimum spread. And in cash flow terms, the estimate of the tax and class 4 liabilities is down here. Well, a taxpayer who would have been used to paying 33,000 ends up with 35,000 in 23-24, drops again in 4-5. But generally speaking, and this will be because of changes in tax rates, we do have an increase in the anticipated tax cash flows. Now, that won't be nearly as bad if we've got overlap relief equivalent to the current level of profit. So with a level of profit of £100,000, 3 months worth of overlap for a December year end would have been 25,000. And if I put that in, I can see straight away that the taxable figures are roughly 100,000 a year. There are obvious rounding differences because of days in the year, leap years, and so on. Let me show you a couple of other things that the app does before getting into the more interesting stuff. As usual, we can toggle between Scottish and non-Scottish. If I look, for example, at the 16,261 second payment on account for 23-4, if I toggle from non-Scottish to Scottish, then that 16,261 goes up to 17,283 because of the higher Scottish tax rates on non-savings income. Similarly, we can toggle state pension age to get rid of national insurance. I've included this year student loan repayments because the way in which these figures work can have a material impact on student loan repayments. So if I toggle that from no to yes, then that'll reveal the student loan repayment, 7,000 a year for this one, as a result of the figures. And there is a separate worksheet for student loan repayments. You can select whether it's plan 1, 2, 4, or post-grad, and it'll automatically populate it with the taxable profit for 23, 4, and 4, 5, and then it'll populate it with the additional income that you will have input on the enter data sheet. So there is this facility for other income and also for net pension contributions or charitable donations. So quite a lot of data to work through there. But where it becomes a little more interesting is if we decide to change accounting date. And although it may be counterintuitive, what happens if we change date from 30 December 22 to 30th of June 23, which we are entitled to? That would be a change during the 23-4 tax year, and that change could be notified to the revenue at any time before you file the 23-4 tax return. And we can see straight away that the profits are then reallocated in this column with 100,000, 49,589. But in fact, it makes very little difference between the old and the new date, not least because the profits remain at a fairly constant level. But the exciting bit is where I then change those profit figures. And let me remind myself off screen what I want to put down. What I'm going to do is change the profit figures to, let's say, 120,000 in the year to 31st December 22, then let's say 150,000. And then for some reason, there's a reduced profit figure in the current period to December 24 of 20,000 before it recovers to, let's say, 150,000 and then 160,000. We're obviously estimating figures way into the future here, 170, 180,000. Now, in that scenario, with a change of accounting date, and again, I've got no overlap relief brought forward at the moment. I'll just double check. I might put some in a moment. Let's have a look at what happens to the assessments. And perhaps the starting point would be to look at the spread figures. And if I don't change accounting date, I'm simply going to be spreading a transitional element of just over 5,000. But if I do change the date, the amount that can be spread more than quadruples to 22,442. And in this video demonstration, I'm not going to go through all of the reasons why that happens. We'll see full workings in a moment, but look at the impact on the tax cash flows for the upcoming 31st July 24 payment, second payment on account of 23/4. There is no difference because that's based on the 22/3 tax, which isn't affected. But when we look at the 31st of Jan 25 payment, there's a massive reduction. It would go down from 59,000 odd to 35,000, just below. So a 24,500 reduction in the upcoming tax liability. That's partly accounted for with lower student loan repayments. So let me just switch off the student loan repayments and see what the effect of that is. We're going to have a lower differential, but still very significant. In 2025, the combined payments will be 29,000, although of course that's a reduced figure of by 29,000, but that will reverse as it reverses in later years. But cash is king, and knowing that you can have that cash flow advantage, overall it'll balance out more or less depending on differential tax rates, might well prompt some to do a counterintuitive change of accounting date. But the main purpose is to see exactly what is going to happen. Let's turn off the change of accounting date. What is going to happen as a result of the basis period reform that we're looking at. There is no change if I turn off the change of accounting date, but it's got the cash flows that we need to advise clients on. So just looking at the other tabs, I think I've already shown you very briefly the tab for student loan repayments, and you can choose whichever plan. The tax and national insurance calculations, including the Scottish options, highly complicated. As with all of our apps, whenever you see hashes appearing, if you click auto fit, that should automatically increase the column width so that the figures show. But you're not often going to want to look at these tabs. They're there for the curious user so that they can see where it is all the figures are coming from. There are the detailed workings for the different profits and a brief reminder of basis period reform. So there it is, our basis period reform app, the only app that does what it does, and it does what it says on the tin. And I do hope that you'll find that useful. Download our demo version if you've not already done so. And if you've got clients who are going to be affected by basis period reform, this is the way to make sure that you advise them in the most efficient way and give them the bad news, if there is bad news, on the increase in their tax cash flow as soon as possible.